Well, welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 20 minutes, we'll talk about the one space that has confounded market participants by the severity of the fall, and that's the small cap space. But if past history is anything to go by, the corrections could be steeper as well. Now, is it right to compare what's happened in the past to the small cap space to the current market and economic cycle? Let's talk about that with Mr. Chandraprakash Padiyar. He's Senior Fund Manager, Tata Mutual Fund, and he manages, amongst other things, the small cap end at the AMC. Chandraprakash, thanks so much for taking the time out. I hope all is well.
Yeah, Neeraj, thank you so much for having me on the show and represent Tata Mutual Fund and especially discussing small cap segment of the market. So things are pretty fine.
Yeah, well, looking forward to this. So, has the correction been steeper than what you anticipated, Chandraprakash?
I would say it's a good beginning, and we actually hope for some more consolidation in the market. So, actually last couple of years has been too good to be true, maybe in the sense that it's been a one-way rally, and without any meaningful correction. My experience in the last 23 years being in the market tells me that some corrections is warranted so that excesses are cleaned up in the market every now and then. So to that extent, I would say it's a good beginning.
Okay. Am I to assume that you believe that the excesses, while some of it may have been, may have gotten cleaned, because stocks have fallen between 25 and 30%, even if the index has fallen about 10-12%, you believe that there is still some more pain left in select ends at the broader end of the spectrum?
Let me give you an answer in a very different way. For example,
Sure.
I manage the Tata Small Cap Fund, and the benchmark index that we track with is NSE Small Cap 250 index. And the fact that my portfolio is 88% plus outside of the benchmark index makes a statement for you. So we do see some part of businesses which are part of the benchmark index where we think at least fundamentally the risk reward is not very favorable. The good news about small cap universe is that we have an extremely large universe to choose from businesses. So if we do better stock selection, we do hope to deliver good performance. But to answer your question, yes, I think in the benchmark indices and even in some part of the universe itself, there is, or in the last couple of years, valuations have moved materially higher relative to fundamentals, and expectations of businesses growing from here also has moved higher. So some amount of correction in those expectations is certainly very welcome.
The bulls, Chandraprakash, argue that if one looks at the earnings performance anticipation of what could happen at the broader end of the spectrum as well, right? Nifty mid cap 100 or Nifty small cap 100 or otherwise, the free float PAT growth for FY24 and 25, the estimates are very strong. So my question is, while there is fear around the space at large, would you believe, and I know you don't have the liberty to take a cash call, so I know you're 100% invested per se, but would you believe that the underlying earnings growth of some of the promising broader end of the spectrum themes is good enough to tide over the current worries as well as the worries of excessive valuations?
So, Neeraj, very true. So, first of all, on fundamentals, I would say that look at the history between 2009 and 2020, for example. Our economy was undergoing a long period of consolidation, real estate, banking sector, all of that. And in fact, in 2000, FY21, if I remember the number correctly, corporate profit to GDP was as low as 1.8%. In the last 2-3 years, they have moved to 4.8 and 4.9%. So we have, and our peak used to be 6.8% in 2009, FY09. So we are, in that sense, we are nearing our peak levels from our corporate, generally for corporate profit perspective. But you must note within these numbers, if you let's say look at the small cap universe and last couple of years of earnings delivery by small caps, what you notice is that a large part of profit growth that we are seeing, especially in the last 1.5 years, has been because of profit margin improvement. There has been a very sharp profit margin improvement across the board, across sectors for companies. Whereas sales growth, and that's part of it is because commodity prices have corrected in the last 1 year. Why? So volume growth is still there, but sales growth is low single digits in that sense. Our view is that incrementally you can margins are already at an all-time high levels across corporates, actually across most sectors today, which means that incrementally you do need to see volume growth pick up or top line to grow, and margins will be either stable or maybe some amount of correction in margin is also warranted given the competition increasing across sectors. So our view is that one needs to be very, very selective in today's market. The earnings growth that we've seen in the last 2 years, and which is what you were highlighting, which is a fact, businesses have done extremely well. But I think, or we believe that incrementally one needs to be very selective on what you buy, and your expectation needs to be different. Or every company will not be able to deliver high top line growth and leading to high bottom line. So choosing the right business will be important. And to some extent, that this segment of the economy or small caps will now be, and we are starting to see that happening already, will be in a capex mode now, which means that some amount of leverage will also start coming in incrementally, though it's still early days, but over the next 2 3 years. So all of those things mean that choosing the right business will be important rather than a general trend. Generally speaking, yes, last 2 3 years have been very positive, very strong on earnings delivery. The next 1 2 years, I would want to be very choosy.
So, when do you restart subscriptions to your fund? Does it happen when valuations reach a particular level, as in, in terms of what the small cap aggregate valuations are, or is it a time correction that you're waiting for? Because you don't sound very optimistic on earnings commentary.
So, as I said, if you talk about my fund portfolio that we've created, I am quite optimistic
Okay.
on earnings. And the reason why we have chosen to be away from the benchmark is that we believe we have been able to identify good businesses where valuations are also reasonable. Having said this, Neeraj, before I come to your point on earnings, the fact is that it is, at least that's what I believe, that people, the investor expectations from a return perspective have certainly moved higher. Given that last 4 5 years, small cap universe has given very high returns, I do sense that investors expect 20% plus returns continuing in the immediate future. And I want to make this a point to say that at least we don't expect very high returns. Even when you do a stock selection, I think repeating 25% CAGR, at least in the next 2 3 years, is not, at least we don't build that as our base case.
So is that a factor of the start? So before we take that break, is that a factor of the current valuations where we are, or is it a factor of weakening earnings growth?
Yeah, I think it is more a factor of incrementally valuations moving higher across the board. And not so much about, okay, let me give you a different thought. When we think about earning growth, after a sharp improvement in margin improvement over the last 2 3 years for most businesses in the small cap, across the board, large cap, mid cap, small cap, now we need top line growth, and that follows once capex increases in the system. In the past 2 3 years, it was the government of India which was spending a lot of and upfronting the capex. Private sector was missing in the picture because capacity utilization generally was 78% and between the 70 and 75%. Now they are moving towards 80. So we do see this trend where capacity expansions will materially move higher over the next 2 3 years across the board, across private sector entities. When this happens is when economic activity picks up significantly, and then top line starts improving. So there is going to be this lag, or there's going to be a gap, maybe in FY25, maybe 25 and 26 2 years, where you will see slightly slower earning growth. Let me put it, let's say last 1 year, small cap 100 index earning growth from trailing earnings, what I see, earning grew by 58 to 60%. Uh, I think the incrementally the next 1.5 years could be more like 10 to 15% kind of a case, and then that cycle increases beyond FY26. So we are in a positive economic cycle, but there for one year, 1.5 years, it is likely to. We should probably, or we will most likely see earning growth growing, but growing at a slower pace, which is why we are saying both valuations have moved higher and earning growth will be normalized instead of very high past numbers on a low base. So at normal levels, your returns are also normal. You cannot expect very high returns.
Okay, viewers, so effectively he's talking about a slightly lower trajectory of earnings growth and maybe even valuations getting derated a little, and a combination of these might be impacting. Maybe that's the gist. We'll try and probe this further. Chandraprakash, I would love to understand, I mean, it's great insights from you, by the way, in the first segment. Now, I'd love to kind of understand what should an average investor who's investing in small cap funds in general, maybe looking to invest in your fund as well, what are the kind of returns that should realistically be expected as a CAGR return, let's say over 2 years or maybe over a slightly longer term?
So unfortunately, I can't give a return expectations, given that I'm not allowed to do that. But I can give you a different way of answering. We will try and answer in a different way.
Please.
The first is that, and this is more a medium to long-term trend that we see happening, is that we see there is certainly a very real shift that we see in manufacturing in India. And I've been in this market for 23 years, and this is the first time we are seeing companies talking about gaining market share in Europe and US, and we hear this more often that we have the technology and we are doing R&D and expanding capacity by 2-3x, 2-3 times in the next 2-3 years, and it is more about demand is there. It is more about how much can we supply. So the language, the tone of management is extremely different than what it used to be in the past. Which is what I was kind of trying to hint at in my earlier remarks, is that there are a lot of companies that we meet today, which are, as we speak, creating capacities in a larger manner. Those capacities will, and plus PLI capacities will also come in by FY26 fully. Our sense is that FY27 and beyond could be a new phase for many businesses to start growing at a faster pace. So if you take a medium to long-term view, and by the way, the reason why I'm talking about manufacturing is that 60-70% of India's manufacturing happens in the small cap universe in India, in the listed. So manufacturing, if you want to take exposure to, then small caps is the place to bet on. Which means that, so what I'm trying to say is that the potential for scalability and higher profit growth is certainly there. There is this 1.5 years of gap that will come in between, and then we'll probably see a higher growth number again, depending on the economic cycle globally and India. And hence we are optimistic. So I would say there is a good chance that people will make decent returns, high absolute returns in their portfolios over the next 3-5 years, provided they can take a long-term view. Having said this, again, from experience, we know this is that long-term, your returns are as good as earning growth. You should not assume valuations to move higher, and averages, for example, last 23 years, mid-cap, small cap, large cap, all universes have delivered between 13 to 15% CAGR return. So normalized returns are in line with your earning growth. And if your earning growth is likely to be between 10 to 15% over the next 2, 3, 4 years, CAGR, then that's the return that you should expect, not higher. And which is where I was kind of hinting at, is that today, unfortunately, expectations of returns is very high. That's what I sense. And hence was trying to caution that if you expect reasonable returns, long-term trend returns, I think you will not be disappointed. But if investors start expecting very high returns of 20, 25, 30% continuing, then I think there is a scope for disappointment.
Okay. The other aspect is, should mutual fund investors be worried at the current point of time if they have SIPs ongoing? Because usually we've seen that the best time to actually accumulate good quality paper, whether it's stocks or funds, is when there's a temporary down cycle on. So not everybody understands. There's a lot of new first-time investors as well, or recent investors as well. Should they be worried about the ongoing SIPs in the small cap, flexi cap, multi cap portfolios, or not quite?
So the answer is depends on what return expectations you have.
Again,
And
okay.
what I was saying is that if your expectations are very high, then you should be worried. But if your expectations are reasonable, normal, long-term trend returns, then I think you should not be worried.
Got it.
SIP should continue and you should keep investing.
Got it. Now, Chandraprakash, a bit of a different question. I mean, it's a mutual fund show, but I'm still asking you an investing question of sorts about what would the construct of your current portfolio be like in terms of themes? I mean, because I heard you say that you are nervous about earnings for the wider market, but for your own portfolio companies, you are not. You expect the earnings growth to be strong. So what are the themes that are the dominant part of your small cap portfolio?
So thank you for this actually. But at Tata Mutual Fund, our investment philosophy is growth at reasonable price. And we look for businesses where businesses can compound earnings at a very fast pace with free cash flows and available at a reasonable price. And we like to say that we are early in the market. So we identify businesses or management teams where there is some trigger in place from an earnings delivery perspective, high capex, technology, R&D, innovation, anything that can lead to higher growth, sustainable growth for a longer period of time. So in Tata Small Cap Fund, in the last 6 months, actually, we've changed our portfolio almost like 60 to 70%. So what the portfolio that you see today is a very new portfolio for investors, keeping in mind the next 3-4 years. So we have churned a lot of portfolio and we've used this rally in the market to churn it and position ourselves in businesses where market is not, or maybe mispricing those businesses because of certain short-term earnings delivery. And hence, and which is what I was highlighting to you, is that small cap businesses are generally in our economy, between 18 to 23, 18 was a very low number. So base effect wise, earning growth was very high by Indian corporates. Similarly, in small caps, the businesses that we've chosen, there is certainly going to be a base effect as well, because the new business that we've chosen for our portfolio, we believe some short-term reasons, many of these companies' earnings are depressed. And over the next 2-3 years, you will see a very sharp pickup in earning growth. That's our expectations. And hence, valuations, what market thinks, and our belief is that valuations are quite attractive. So it's a call in terms of delivery of earnings by those managements. And from a thematic perspective, a large part of our businesses are manufacturing, supply chain, and logistics companies. Apart from that, we do have certain select consumer businesses and services oriented businesses. So that's where we are. But the good news is that a large part of a portfolio does not have leverage on the balance sheet as well. So the risk levels are fairly low.
Got it. We have 60 seconds, Chandraprakash. Just manufacturing is a very wide theme. Chemicals to PLI to what have you. I mean, what is the larger presence in manufacturing within the portfolio?
For us, it is more engineering, capital goods, and industrial companies. That's where we are largely present.
Okay, and in consumers, what would the preference be?
There is more branded companies where businesses are premiumizing. So one is alcohol, one is consumer company, branded companies where business is premiumizing.
Okay, gives a fair idea. And thank you for sharing that thought. Thank you for giving us those insights as well. Good to see a calm fund manager managing the small cap space at a period of time which is undergoing a bit of a turbulent phase. But much appreciate your time, Chandraprakash.
Thank you.
Thank you. And viewers, thanks for tuning in.